Listen carefully. The market does not pay the trader who is most excited. It does not pay the trader who is most active. It does not pay the man who jumps in and out of positions, like a nervous gambler standing at a horse race. The market pays the man who can sit still when sitting still is the hardest thing in the world. Most traders do not lose because they cannot find a good trade. They lose because when they finally find one, they cannot hold it. They spend days waiting for the perfect setup. They study the chart. They mark the trend. They watch the breakout. They enter at the right price. And then, the moment the trade moves in their favor, fear enters the room, not danger. Fear. The trade is working, but the trader is suffering. He sees a small profit and his mind whispers, "Take it now, don't lose it." So he exits. He feels relief for a few minutes. Then the market continues without him. The stock climbs. The candle expands. The trend strengthens. What could have been a great trade becomes a small, forgettable profit. And the trader sits there watching the move he waited for, the move he predicted, the move he entered correctly, happen without him. That pain is different from a normal loss. A normal loss hurts the account, but exiting a winner too early hurts the mind, because deep down you know you were right. You were right about the setup. You were right about the direction. You were right about the opportunity, but you were not strong enough to stay. And that is where most traders fail. They are not defeated by the market. They are defeated by their own inability to let a winner become a winner. I learned early that the money in speculation is not made by buying and selling. The money is made by sitting. That sounds simple. But there is nothing simple about it, because when real money is on the line, sitting feels like doing nothing, and most traders cannot tolerate doing nothing. They need movement, they need confirmation, they need the comfort of action. They want to click, they want to adjust, they want to take profit. They want to protect themselves from the very uncertainty that creates the big money. But the market does not reward comfort. The market rewards discipline. There is an old mistake that repeats in every generation of traders. A man buys a stock at 50, it rises to 53. He takes his profit. He feels clever. Then the stock goes to 60, then 70, then 90. And now he tells himself, "I knew it. I knew that stock was going higher." Yes, he knew. But knowing was not enough. He did not have the courage to hold. Another man buys a stock at 50. It drops to 47. He refuses to sell. It drops to 44. He tells himself, "It will come back." It drops to 40. Now his small loss becomes a large loss. So you see, the sickness. The average trader cuts his winners quickly and holds his losers stubbornly. He does the exact opposite of what successful speculation demands. He treats profits as fragile and losses as temporary. He protects small gains and gives huge freedom to bad trades. That is not trading. That is emotional confusion, dressed up as strategy. The market is a mirror. It reflects your discipline. It reflects your impatience. It reflects your fear. It reflects your greed. And most of all, it reflects your habits. If your habit is to grab small profits, the market will train you to stay small. If your habit is to tolerate large losses, the market will punish you until you change or leave. There is a rule. I want you to remember, never be in a hurry to take a profit simply because it is a profit. A profit alone is not an exit signal. Read that again in your mind. A profit alone is not an exit signal. Most traders think the purpose of a trade is to make money quickly. That is wrong. The purpose of a trade is to follow the market correctly. Money is the result. A trader who focuses only on the money becomes emotional. A trader who focuses on the market becomes disciplined. When you enter a trade, you should already know three things: where you are wrong, where you will reduce risk, and where you will allow the market to prove the trade. That is the foundation of intelligent exit management. Not hope, not panic, not random profit taking. A proper exit is not one decision. It is a process, and today I will give you a simple three-step exit rule, a rule that can help you stop killing your best trades too early, a rule built on one principle: take some profit when the market gives it to you, protect the position when risk demands it, and let the final part run as long as the market remains in your favor. 3 steps. Take partials. Trail your stop. Let winners run. Simple words, difficult execution. Because the problem is never the rule. The problem is the trader. Let us begin with the first step. Step 1. Take partial profits, but do not kill the trade. There is nothing wrong with taking profit. A trader who never takes profit is not disciplined. He is greedy, but a trader takes all his profit too early is not cautious. He is afraid. The purpose of partial profit is psychological balance. It allows you to pay yourself without abandoning the opportunity. Imagine you buy a stock at 100. Your analysis says the stock has potential to move toward 120, or even 130 if the trend continues. The stock moves from 100 to 108. Most traders see that profit and feel pressure. They say, "What if it comes back?" So they sell everything at 108. They make 8 points. Good. But then the stock moves to 115, then 122, then 130. Now they are angry, not because they lost money, but because they made too little from a correct idea. A professional trader thinks differently. At 108, he may sell a portion, maybe 1/3, maybe 1/2. He locks in some profit, but he keeps part of the position alive. Why? Because he understands that a strong trend can pay far more than a quick exit. The partial profit quiets the fear. The remaining position gives the market a chance to reward patience. This is balance. A trader must never become so greedy that he refuses to take anything, but he must never become so fearful that he takes everything. Partial profits are not about predicting the top. They are about reducing emotional pressure. Once you have taken a portion off, your mind becomes clearer. You are no longer thinking, "I must not lose this profit." You are thinking, "Now let me manage the rest." That is a different mental state, and trading is largely a game of mental state. The amateur exits because he wants emotional relief. The professional exits because the market gives him a reason. There is a big difference. Let me tell you a common story. A trader enters a breakout. The stock breaks above resistance. Volume increases. The market is strong. He enters correctly. The stock moves up 3%, then 5%, then 7%. He becomes excited, then nervous. He checks the chart every minute. He looks at his profit and starts imagining it disappearing. The market pulls back slightly, not a trend reversal, just a normal pullback. But the trader cannot handle it. He sells everything, then the stock builds a base, breaks higher again, and continues. He says, "The market tricked me." No, the market did not trick him. His fear tricked him. He did not have an exit plan. He only had an entry. And an entry without an exit plan is like walking into a storm without knowing where shelter is. Before you enter any trade, you must decide how you will scale out, not after the trade moves before. Because once money is moving, Your emotions will negotiate against your discipline. They will say, just take it now. They will say, don't be stupid. They will say, profit is profit. And yes, profit is profit, but small profit from a large opportunity is still poor execution. Do not confuse winning with trading well. Many traders win small and still trade badly. They just do not notice it yet. The first step is not to exit all. The first step is to take partials when the trade has given a reasonable move. That reasonable move can be based on resistance, risk-reward, previous highs, market structure, or volatility, but it should not be based on fear. Never let fear be your profit target. Now we come to the second step. Step 2. Trail your stop. This is where the trader must learn the difference between protecting profit and choking the trade. After partial profit, your next job is not to guess the top. Your next job is to protect the position without suffocating it. A trailing stop is a moving line of discipline. It says, as long as the market continues to behave correctly, I will stay. But if the market proves the move is weakening, I will exit. This is how a trader transfers control from emotion to structure. There are many ways to trail a stop. You can trail below higher lows. You can trail below a moving average. You can trail below a trend line. You can trail below key support. You can use volatility. The method matters less than the discipline to follow it, because most traders do not lose from not knowing where to trail. They lose because they move the stop emotionally. A stock rises. They move the stop too tight. The stock breathes normally. They get stopped out. Then it continues higher. This happens because the trader wants certainty, but the market never gives certainty. A trend does not move in a straight line. It advances. It pauses. It pulls back. It shakes weak hands. Then it continues. If your stop is too tight, you are not managing risk. You are demanding perfection. And the market does not reward perfectionism. It rewards patience with structure. A good trailing stop gives the trade room to breathe. Think of a winning trade like a strong horse. If you pull the reins too hard, you slow it down. If you let it run wild with no control, it may throw you off. The art is balance. Enough room to run, enough control to protect. That is the purpose of the trailing stop. Let us use an example. You buy a stock at 50. Your initial stop is 47. Your risk is 3 points. The stock moves to 56. You take partial profit. Now you move your stop on the remaining shares to break even or slightly above. Now the trade cannot hurt you badly. If the stock continues to 62, you trail the stop below the latest higher low. If the stock pulls back but holds structure, you stay. If it breaks the structure, you exit. This sounds ordinary, but emotionally, it is not ordinary. Because when the stock pulls back from 62 to 59, you will feel fear. When it drops to 58, you will want to sell. When the profit decreases on the screen, your mind will treat it like a loss. But it is not a loss. It is fluctuation. This is where most traders misunderstand profit. They think every dollar of unrealized profit belongs to them. It does not. Unrealized profit is not yours until the market confirms your exit while you are in the trade. That profit is market property. You are renting it. You earn the right to keep more of it through discipline. A trader who cannot watch unrealized profit fluctuate will never catch a big move. He will always escape too early. He will always protect himself from discomfort, and in protecting himself from discomfort, he will protect himself from greatness. Trailing stops teach humility. They admit, I do not know where the top is. This is important. Most traders secretly want to sell the top. They want the perfect exit. They want to say, I got out at the high. That is vanity, and vanity is expensive in the market. You do not need the top. You need the meat of the move. The middle of the move is where fortunes are built. The top and bottom are for liars and lucky men. A professional trader does not need to catch every point. He needs to follow the line of least resistance while it remains intact. When the trend is up, stay with it. When the trend weakens, reduce. When the trend breaks, exit. This is simple. But again, simple does not mean easy, because the market will test your patience. It will make you doubt. It will make you feel foolish for holding. It will tempt you to grab quick money. It will show you profits and then pull them back just enough to scare you. That is the test. The market wants to know, are you a speculator, or are you merely a frightened man with an open position? Step 3. Let winners run. This is the step that separates small traders from great traders. Anyone can take a small profit. Anyone can feel clever for a moment, but very few can hold a winning position through normal corrections, through noise, through the opinions of others, through boredom, through fear, through greed, through every emotion that tries to cut the trade short. Letting winners run does not mean holding forever. It means staying with the trade while the reason for the trade remains valid. That is the key. The amateur says, I am up enough, I should sell. The professional says, is the trend still intact? The amateur says, this profit feels big. The professional says, has the market given me an exit signal? The amateur trades his feelings. The professional trades the facts. Letting winners run is not blind optimism. It is obedience to strength. When a stock is acting right, leave it alone. When the market confirms your idea, do not punish the trade by exiting too soon. Many traders are kind to their losers and cruel to their winners. They give losers time. They give winners no patience. A losing trade goes against them, and they say, let me wait. A winning trade goes in their favor, and they say, let me escape. This is backwards. You must be ruthless with losses and patient with winners. A loss is a business expense. A winner is a business opportunity. Do not reverse the two. The big money is not made in the first small move. It is made when a correct position becomes obvious to everyone else after you are already in. The early move rewards observation. The middle move rewards conviction. The final move rewards discipline. Most traders get paid only for observation. They see the setup, they enter, they grab a small profit, but they never get paid for conviction. They never get paid for discipline because they leave before the market has time to expand. Let us imagine a trader watching a stock for weeks. The stock is forming a base. It refuses to break down. Volume dries up. The general market begins to strengthen. Then suddenly the stock breaks out above resistance. The trader enters. The stock moves higher. Everything is working. But instead of trusting the setup, the trader exits for a small gain. Why? Because he does not believe he deserves a large one. This is a silent problem. In trading, many traders say they want big winners, but emotionally, they are uncomfortable with them. A large open profit feels dangerous. It feels unreal. It creates pressure. The trader thinks, I cannot let this disappear. So he makes it disappear himself by exiting too soon. He calls it discipline. But it is fear. Real discipline is following your plan. Fear disguised as discipline is still fear. You must learn to tell the difference. There is nothing wrong with protecting profit, but there is something deeply wrong with destroying opportunity, because you cannot tolerate uncertainty. Every great trade will make you uncomfortable. Remember that. A trade that has the potential to change your month, your quarter, or your year will not feel easy while you are holding it. It will test you. It will shake you. It will move against you temporarily. It will invite doubt. That is normal. The market does not hand out large profits to men who require emotional comfort. Now I want to speak about market psychology. Why do traders exit winners too early? The first reason is fear of giving back profit. This fear is natural, but natural does not mean useful. A trader sees green on the screen and immediately becomes defensive. He thinks the profit is fragile. He wants to protect it, but he protects it so aggressively that he prevents it from growing. It is like planting a tree and digging it up every day to check the roots. You cannot grow wealth that way. The second reason is lack of trust in the setup. Many traders enter trades they do not truly believe in. They enter because of a signal, a video, a rumor, a feeling, or fear of missing out. So when the trade starts working, they are not calm. They are surprised. And because they are surprised, they exit quickly. A trader who does not trust his process cannot hold his winners. Confidence does not come from positive thinking. Confidence comes from preparation. You must know your setup. You must know your risk. You must know your exit plan. Then, when the trade moves, you are not begging the market. You are managing business. The third reason is small account thinking. A trader with small account thinking wants every trade to pay immediately. He is desperate for quick proof. He takes small profits because small profits feel like progress, but the market does not care about your need for progress. It moves on its own schedule. If you force quick profits, you may survive for a while, but you will rarely grow. Growth requires asymmetric trades. Small losses, controlled risk, large winners. But you cannot have large winners if you keep selling them while they are still small. The fourth reason is pain from past losses. A trader who has been hurt by the market becomes defensive. He remembers the times when profit turned into loss. So now every profit feels temporary. He exits fast because he does not want to repeat the pain. But if he never changes his structure, he remains trapped by memory. Past losses should teach discipline, not fear. A trader must not let old wounds manage new trades. The fifth reason is watching the profit and loss instead of the chart. This is one of the greatest mistakes. The pendulum is emotional, the chart is structural. The pendulum says, you are up $300. The chart says, the trend is still intact. The pendulum says, you lost $100 of open profit. The chart says, this is only a normal pullback. The pendulum makes you reactive. The chart makes you rational. If you trade by your pendulum, you will exit based on comfort. If you trade by structure, you will exit based on evidence. A serious trader must train himself to see the market first and the money second. Now let us walk through the three-step exit rule like a complete trade. You find a stock in an uptrend. It has been consolidating for several days. The market is strong. The sector is strong. The stock breaks above a key level with volume. You enter at 100. Before entering, you define your invalidation. If the stock falls below 96, the setup has failed. That is your initial stop. You are risking 4 points. Now the stock moves to 108. This is 2 times your risk. At this point, you take partial profit, not all. A portion. You reduce pressure. You pay yourself. You prove that the trade is working. Now you move your stop on the remaining position, maybe to break even, maybe below the breakout level, maybe below the latest higher low. Your job is to remove disaster risk. Now The stock moves to 115. You do not sell everything just because the profit looks good. You ask, is the trend still healthy? The stock forms a higher low at 111. You trail your stop below 111. Then the stock moves to 122. Now the crowd notices. Commentators begin talking. Social media becomes excited. Traders who ignored the breakout now want in. This is where many moves accelerate. You are already in. Your job is not to predict the top. Your job is to let the market carry you. The stock pulls back to 118. You feel pressure, but your trailing stop is below structure, so you stay. Then it moves to 130. At this point, maybe the stock becomes extended. Maybe volume shows exhaustion. Maybe it breaks a key moving average. Maybe it violates the pattern. Now you exit the final portion. Not because you were afraid, not because you wanted comfort, but because the market gave evidence. That is professional exit management, partial profit, trailing stop, let the winner run. This method does not guarantee the biggest possible profit. Nothing does, but it prevents the worst habit, turning every good trade into a small trade. You must understand something about large winners. They often begin like ordinary winners. At first, you cannot know which trade will become exceptional. That is why you must give your best trades room. If you cut every trade at the first sign of profit, you will never discover which one could have paid big. The large winner is rarely obvious at the beginning. It reveals itself through behavior. Does the stock hold higher lows? Does it recover quickly from pullbacks? Does volume support the move? Does it resist market weakness? Does it move with leadership? Does it keep proving strength? If yes, why are you selling? Because you are scared. Because the profit looks nice. Because you want to feel safe. Safety is not the goal. Proper risk is the goal. There is no safety in speculation. There is only intelligent risk and foolish risk. Taking a partial is intelligent. Moving a trailing stop is intelligent. Selling the whole position simply because you feel nervous is foolish. The market does not care how nervous you are. It only cares whether you are positioned correctly. Now, let us talk about the phrase that ruins traders. No one ever went broke taking profits. This phrase sounds wise, but it is dangerous when misunderstood. No one goes broke taking profits. But many traders stay mediocre taking profits too early. Many traders fail because their average winner is too small to pay for their average loser. They win often and still lose money. Why? Because their winners are tiny and their losers are heavy. A trader can be right 60% of the time and still lose if he cuts winners short and lets losses grow. Another trader can be right only 40% of the time and still make money if his winners are large and losses are controlled. This is the mathematics of speculation. You do not need to be right all the time. You need your right trades to matter. That is the point. Your winners must matter. A winner that is cut too early does not matter enough. It may feel good. It may look green, but it does not change the curve. Great trading is not about being right. It is about making enough when you are right and losing little when you are wrong. That is the whole game. Now, ask yourself, honestly, when you enter a trade and it moves in your favor, do you become calm or anxious? Do you follow your plan or watch every candle? Do you take partials with structure or sell everything out of fear? Do you trail your stop logically or move it too tight because you cannot handle fluctuation? Do you let the final portion run or kill the trade before it has a chance? Your answers will tell you the truth about your trading. not your strategy, your psychology, because the chart may give you the opportunity, but your psychology decides how much of that opportunity you keep. Most traders are obsessed with entries. They want the perfect entry. They study indicators. They test moving averages. They search for secret patterns. They think the entry is everything. The entry is important. But the exit determines the size of the result. A good entry with a poor exit becomes ordinary. A decent entry with an excellent exit can become powerful. The market often gives more money to the trader who manages well than to the trader who enters perfectly. Do not worship the entry. Respect the exit. The exit is where your true character appears. Anyone can click buy. Anyone can enter a trade, but holding a winner requires patience. Scaling out requires judgment. Trailing a stop requires discipline. Letting the final piece run requires emotional maturity. That is why the exit separates amateurs from professionals. Let me give you another example. Two traders enter the same stock at the same price. Trader 1 buys at 40. Trader 2 buys at 40. The stock rises to 44. Trader 1 sells everything. He makes 10%. He feels satisfied. Trader 2 sells 1/3. He moves his stop. The stock rises to 50. Trader 2 holds. The stock pulls back to 47. Trader 1 says, "Good thing I sold." Trader 2 watches structure. The higher low holds. The stock rises to 58. Trader 2 trails again. The stock finally breaks structure at 55. Trader 2 exits the rest. Now both traders were right, but only one was paid properly. The difference was not the entry, it was the exit. This is why two people can take the same trade and have completely different careers. One sees profit as something to grab, the other sees profit as something to manage. One wants relief, the other wants execution. One trades for emotional comfort, the other trades for long-term performance. You must decide which trader you will become. Now, do not misunderstand me. Letting winners run does not mean becoming stubborn. There is a dangerous mistake on the other side too. Some traders here let winners run and use it as an excuse to never sell. They watch a winner turn into a loser and say, "I am being patient." No, that is not patience. That is denial. Patience follows strength. Denial ignores weakness. If the stock breaks your trailing stop, you exit. If the trend changes, you exit. If the market invalidates the reason for the trade, you exit. You do not marry a position. You manage it. The market owes you nothing. A winner can become a loser if you abandon discipline. So the three-step rule must be complete. Partials without trailing stops can still become careless. Trailing stops without letting winners run can become too defensive. Letting winners run without any stop can become reckless. The power is in the combination. Step 1 gives you psychological relief. Step 2 protects your capital. Step 3 allows exceptional profits. Together, they form a mature exit plan. This plan helps you stop behaving like a frightened beginner. It helps you think like a market operator. Now, let us talk about the internal battle. The moment you are in a winning trade, you will hear two voices. One voice says, "Take it now, you can always re-enter." Be careful with that voice. Sometimes you can re-enter, but often you will not. The stop may not give you a clean second chance, or you may hesitate, or you may re-enter higher with worse risk. Many traders exit early, then chase the same stock later at a worse price. That is emotional damage. They sell strength, then buy excitement. They exit when they should hold. and re-enter when they should wait. This is why early exits create more mistakes. The second voice says, hold everything forever. This is the big one. Be careful with that voice too. That is greed. The professional listens to neither fear nor greed. He listens to the plan. He says, I will take partials here. I will trail my stop there. I will hold the rest while the trend remains intact. That is calm. That is professional. That is the voice you must build. And you build it through repetition. You cannot become disciplined by inspiration alone. Motivation may help you start, but rules help you survive. Every trade must be reviewed, not only whether you made money, but whether you followed the exit plan. Ask yourself after each trade, did I take partials where planned? Did I trail my stop based on structure? Did I let the winner run? Did I exit because of evidence or emotion? Did I obey the market or obey fear? This is how you improve. The market is a severe teacher. It will repeat the lesson until you learn it. If you keep exiting winners too early, the market will keep showing you what patience was worth. If you keep holding losers too long, the market will keep showing you what discipline would have saved. The lesson does not change. Only the price of the lesson changes. Now let me speak to the trader watching this who says, I always exit too early. Good. At least you see it. Most traders never see their own pattern. They blame the market. They blame manipulation. They blame news. They blame algorithms. They blame everyone except the person making the exit decision. But once you see the pattern, you can change it. Start small. On your next winning trade, do not try to become a hero. Do not force yourself to hold everything. Use the 3-step rule. Take a partial. Move your stop logically. Let the final portion run, even if the final portion gets stopped out. You have practiced discipline. That matters. Because your goal is not to win one trade. Your goal is to build the habit of correct trading. One trade means little. Your process means everything. A trader with a strong process can survive bad periods. A trader with no process will eventually destroy good luck. This is why I say, do not measure yourself only by profit. Measure yourself by execution. Profit follows execution over time. Poor execution may still make money today, but it plants the seed of future loss. Good execution may still lose today, but it builds the foundation for long-term success. The serious trader thinks in probabilities, not emotions, not single trades, not ego, probabilities. If you consistently cut losses and let winners grow, the mathematics begins to favor you. If you consistently cut winners and hold losses, the mathematics turns against you. No motivation can overcome bad math. No confidence can overcome bad habits. No indicator can save a trader who refuses to manage exits properly. Now I want to return to the central idea. Most traders exit winners too early because they are trying to avoid pain. But trading success requires you to accept the right kind of pain. There is bad pain and good pain. Bad pain is holding a losing trade beyond your stop. Bad pain is averaging down without a plan. Bad pain is revenge trading. Bad pain is watching discipline disappear. Good pain is holding a winning trade through normal fluctuation. Good pain is waiting for confirmation. Good pain is not touching the trade when the plan says do nothing. Good pain is letting the market work. Most traders avoid good pain and accept bad pain. They cannot tolerate a winner pulling back slightly, but they can tolerate a loser destroying their account. That is madness. You must reverse it. Become allergic to bad pain. Become comfortable with good pain. Let the winner breathe. Cut the loser quickly. This is the trader's way. If you want to trade like a professional, stop asking, how much profit can I take right now? Start asking, what is the market telling me? Is the trend intact? Is price holding above key levels? Are higher lows forming? Is volume supporting the move? Has the reason for entry changed? Where is my trailing stop? How much have I already taken off? What does my plan require? These questions create clarity, and clarity protects you from emotional exits. A trader without questions reacts. A trader with rules responds. Now, here is the three-step exit rule one more time. First, take partial profits after the trade gives a meaningful move. This reduces pressure and rewards correct analysis. Second, trail your stop based on structure. This protects capital and keeps you from giving back too much. Third, let the remaining position run while the market continues to prove strength. This is where the big money becomes possible. Do not overcomplicate it. The more complicated your exit plan, the easier it becomes to break. Simple rules followed consistently beat complex rules abandoned emotionally. Remember this, the market does not require you to be brilliant. It requires you to stop being foolish. Do not be foolish with winners. Do not treat them like accidents. Do not rush them out of fear. Do not suffocate them with tight stops. Do not kill them before they mature. A good trade is rare. When you find one, respect it, protect it, manage it. Let it pay you. There will always be another trader taking quick profits and celebrating. Let him celebrate. There will always be another trader bragging about catching the top. Let him brag. Your job is not to impress anyone. Your job is to build an account over time, quietly, patiently, professionally. The market has no sympathy for the impatient man. It has no mercy for the undisciplined man, but it can reward the man who understands himself, the man who can enter with courage, reduce with discipline, protect with structure, and hold with patience. That man is rare, become rare, because in the end, the difference between a small trader and a great trader is not always intelligence. It is not always information. It is not always speed. Often, it is the ability to sit still in a winning trade while every emotion begs you to leave. Most traders exit winners too early. Do not be most traders, take partials. Trail your stop. Let winners run. And never forget, the market pays patience only after it has tested it. So when your next winner begins to move, do not ask for comfort. Ask for discipline, because comfort will make you small. Discipline will make you dangerous. And in the market, the patient man with a plan is always more dangerous than the excited man with a profit. Trade carefully. Think clearly. Cut losses quickly. And when the market gives you a true winner, do not insult it by leaving too soon.